So let's look at how we calculate these short-run measures of shareholder investment returns, and we start with the return on capital employed. And what we're looking at here is, well, how well has the business used its capital to provide a return to the providers of that capital? The providers of that capital are the equity holders, the shareholders, and the debt holders, the providers of loan finance. So what we're looking at is the profit before any finance costs divided by the level of capital employed. And this is the formula that you need to learn. Okay, so we're looking at how efficiently has the capital been used by the business to generate a return for its investors, the providers of capital. So we're looking at the profit from operations, profit before interest and tax, divided by the capital employed, and that is your total assets less your current liabilities, which can also be calculated as the long-term debt plus equity. And strictly speaking, we should multiply by 100 because it's a percentage measure. Now, sometimes you will need to calculate, rather than just the capital employed at the end of the year, you might need to calculate the average capital employed. And the average capital employed is the capital employed at the start of the year plus the capital employed at the end of the year divided by 2, and that will give you the average capital employed. So if you're given the capital employed at the start of the year and the capital employed at the end of the year, the question will expect you to calculate return on capital employed based on the average capital employed. Now let's take a look at this first example. So we have some financial information. So this is information taken from the income statement of this company, and this is information taken from the statement of financial position. So remember, what we are interested in is the profit from operations. Okay, so that's our profit before interest and tax, profit from operations divided by our capital employed, and what we are looking for is our total assets less our current liabilities. So if we look at our information from the statement of financial position, we have the non-current assets. If we add the current assets and deduct the current liabilities, that will give us our total assets less our current liabilities, and that gives us 700,000. So if we want to put that into our calculation, so return on capital employed is equal to our profit from operations, 100,000, divided by the capital employed, 700,000, multiplied by 100, and that will give us, if you work that out, 14.3%. Now, if we had information for the capital employed at the start of the year, we could have worked this out based on average capital employed, but we don't have that information for this particular question. Okay, the next measure we have is earnings per share, and this is widely used in the stock market, where investors are looking at the earnings made by listed companies. And what's important from an investor's point of view or a shareholder's point of view is that that earnings per share figure is increasing. An increasing earnings per share figure will mean that shareholder wealth is increasing. So again, this is a formula that you will need to learn. So we have earnings per share is equal to the profit available for the ordinary shareholders. So that will be the profit after tax. So it's the profit after tax and preference dividends, but it will be before ordinary dividends, because we want to know what's available for the ordinary shareholders, and we divide by the number of shares in issue, the number of equity shares in issue. So let's have a look at this next example. So we have profit from operations, finance costs, and that's our profit before tax. Then we've got our tax, and then we have our profit after tax. Then we have dividends, and that takes us to our overall net profit. Now, what we need to consider with that dividend number is, well, does it include any preference dividends? Because what we want to work out for our profit number is the profits after tax and after preference dividends. So if there's any preference dividends in there, we need to deduct that from our profit after tax. So we're told the dividend figure includes the annual dividend on 6% $1 preference shares. So that 15 million of dividends includes preference dividends. Now, preference dividends pay the same dividend each year. It's 6%. So what we need to do is take 6% on the number of preference shares. So we have 100 million preference shares, each of a nominal value of $1. So 6% multiplied by 100 million will give us the preference share dividend. If we work out 6% of 100 million, that's obviously 6 million. So that 15 million of preference of total dividends includes 6 million of preference share dividends. So we want to work out our profit after tax and preference dividends. So we start with our profit after tax number, which is 34.1 million. And if we take off the preference dividend, which is 6 million, that will give us a profit of 28.1 million. So that's the profit available for the ordinary shareholders. So that's basically our top part of the equation, the profit available for ordinary shareholders, and we need to divide that by the number of issued shares. And the number of issued ordinary shares, that's what's important, the number of issued ordinary shares is 200 million. Don't worry about number of authorized shares, that's simply saying, well, how many shares is the company allowed to issue? The number of issued shares is how many shares has the company actually issued. So if we divide by the number of issued shares, 200 million, that will give us our earnings per share, which is $0.1405 per share, essentially 14 cents per share. Now, in terms of one of the problems really with the return on capital employed and earnings per share, we are really only reporting historic performance because it's based on your latest year's profit number. What a lot of investors are going to be more interested in is the likely future performance of the company, and that will give them a better indication of the future value of the company and whether it's worth buying shares in this company. We have another measure that helps us gauge the likely future performance of the company, and this is known as the PE ratio. And the PE ratio is equal to the share price of the company divided by the earnings per share. The PE ratio will always be a number, it's not going to be a percentage. So as an example, let's say we have company A and company B, and we have an earnings per share of, let's say, for company A 10p, company B 10p, and then we've got a share price of company A of 100p. Now, even though company B has the same earnings per share, let's say its share price is 200p. So if we were to work out the PE ratio for these companies, we take the share price and divide by the earnings per share. So for company A, it's going to be 10, and for company B, the PE ratio is going to be 20. Now, what the PE ratio represents is the stock market's perception of future growth potential of the company. So although both companies have an earnings per share of 10, the fact that company B has a higher share price indicates that the stock market has greater confidence in the future earning potential of company B, which is why it has a higher PE ratio. A higher PE ratio means that there's going to be higher investor confidence in the company's ability to generate future profits.